The AI boom feels like 1999 all over again, right before the dot-com bubble burst. The same warning signs that appeared then are flashing again today. Here are 4 historical red flags to help you spot a failing stock before it's too late. This is about protecting your capital by seeing the clues the market leaves behind. First, extreme valuations. The Shiller-Cape ratio, which has a historical median of about 16, is now around 40. This is near its dot-com peak of 44 and puts valuations in the 99th percentile, historically pointing to poor 10-year returns. Another metric, the Buffett indicator, is at 221%. Warren Buffett called levels near 200% playing with fire. In a market this stretched, stocks built on hype are vulnerable. Second, a fragile market propped up by a few stocks. Today, the Magnificent Seven stocks have an outsized influence on the S&P 500's value. This creates a dangerous illusion of strength. The signal to watch is the gap between the main S&P 500 index and the equal weight S&P 500. When the leaders lag while the rest of the market advances, as they have in early 2026, the old leaders are at risk. Third, a capital spending arms race without guaranteed profits. Fueled by AI, a handful of tech hyperscalers are projected to spend over $600 billion on capital expenditures in 2026 alone. This is similar to the dot-com era's build it and they will come phase, which ended when profits didn't arrive fast enough. A stock is at risk when its spending on the promise of AI outruns the actual profits from AI. The fourth flag is a subtle shift in investor psychology from euphoria to anxiety. For the week ending February 18, 2026, the AAII Investor Survey showed bullish sentiment falling below its historical average for the first time in 12 weeks. This suggests investors are becoming more cautious, rotating out of market leaders into safer assets. The real danger sign is when a stock stops rising on good news. It shows the narrative has broken, and investors now demand proof of profit, not just a story. So the 4 red flags: extreme valuations, narrow leadership, a CapEx arms race, and shifting sentiment. This isn't a signal to panic sell, but to be an informed investor. Check if your company's earnings are real and their spending is justified. Learn the difference between true innovation and speculative hype. If this was helpful, subscribe for more.